The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Welcome to the RetailStat Building Suppliers and Home Improvement Executive Review. We're just going to give people a couple more minutes to log on, and then we'll get started. Okay, I think we're going to get going here. Again, welcome to the Building Suppliers and Home Improvement Executive Review. Michael and Franco, I'm an analyst here. I'm with Jerry Machado, also covering building suppliers and home improvement retailers. And we're going to go over some spotlight companies today. We're going to go over some metrics that we'd like to keep you informed about as far as what to look for in companies that you're covering and researching. And we're going to go over some pertinent information about the housing market. So with that, let's go to our first slide, market factors that are affecting the companies that we cover. And this is just an overview of the whole situation that we're dealing with here with all the companies we cover. Main points are high interest rates and inflation are really significant headwinds. Even though they're a little bit below peak, the damage has been done. And prices, though they're slowing down, they're still elevated from where they were before inflation really kicked in. Also, rising borrowing costs are a problem. Affordability is being eroded. Important thing here to note, Americans are spending 41% of their income on monthly housing payments. You have to go back to 1984 to find similar conditions that Americans were dealing with. It's a long time. It's 40 years ago. And, so it's definitely something that people are not used to. You have at least a full generation of people who've never dealt with anything at the height we are now as far as borrowing costs. On the builder side, they are still struggling, even though a lot of the pandemic related problems have subsided. There are still supply side concerns, and there's also affordability issues. On the supply side, some electrical equipment is still hard to find and scarce to source, and lot availability is also a little bit of a problem for some builders. Then finally, companies overall in this sector, we believe that companies with a considerable share of revenues that are coming from government and infrastructure are going to outperform residential-focused building products manufacturers. And even though we say at least through the end of 2023, we would expect that to move into 2024. Definitely residential is taking a harder hit. And, for some reason, government always seems to find a way to get some money to spend. I don't know how they do that sometimes. But if you look at the chart we have at the bottom of the slide, it just gives you an idea of where comps have been going over the past year. We show an 8.2% comp in third quarter of last year, and we've consistently moved downward. Now we're at -7 average as of 2Q. So with that, we'll do a little overview of the housing market. If you don't like the weather in New England, you should wait 5 minutes because it'll change. That's a lot of what we're seeing as far as the housing market. There's really not much of a clear trend that makes you say, well, in the first quarter, we really expect this, or in the first half, we really expect this to happen. There are just a lot of mixed messages, a lot of mixed data points that really leave things very, very muddled right now. So if we look at the data that we have now, like if you look at October 2023, home prices were down 2.3% year to year. Median price was $409,000 and change. That's down 18% from a year ago. So the lack of demand has been pushing prices down, and the number of existing homes, which is really where a lot of the problem is generated from over here. The number of existing homes are down 4.1% from September, and the seasonally adjusted rate was 3.9 million in October. Year over year, sales are down 14.6%, and that's down from 4.4 million in 2022. The inventory of existing homes has been very, very scarce, very tight, and that's really where a lot of the issues are cropping up as far as the performance of the home improvement retailers and that kind of thing. And that's hampering home. National average 30-year fixed rate mortgage is 7.25%. That's down from about 8 in October, but it's still stubbornly high. Again, it's like I had said when we talked about 1984 for the amount of income. People aren't used to this. It's not unprecedented. The average mortgage rate over the past 50 years has been about 7.5%. But this makes people uncomfortable. They haven't lived with this in a long time. So it's a question of how long will it take to get used to it as well. So if we have few existing homes for sale, is it going to be new construction to the rescue? What do we think about that? It's maybe yes and maybe no. Again, with mixed messages that we're getting with a lot of the data. Newly constructed homes fell 5.6% in October. The seasonally adjusted rate was 679,000. That was from a revised rate of 719. Sales were up to 17.1% from a year ago. So you would say off the hand, you'd say that's good. We're up 17%. But here, what we need to say here is new homes now are accounting for 30% of the homes on the market. And that's 2 times pre-pandemic levels. Again, a point where we're not used to. From 2000 to 2019, the average was about 13%. So new builds are trying to fill the void that we have from not having existing homes for sale. And new houses on the market at the end of October for sale, 439,000. That's representing about 7.8 months of supply at the current rate. But average, you're looking for about 4 to 5 months. So when you look at this metric, there's a little bit of a glut in new housing. Obviously, new construction has benefited from the low inventory of existing housing, but they still have the affordability issues as well. You're still paying more for a new home. On the builder side, they have their own challenges. They're dealing with high interest to buy and develop land, and there's still high material costs going on, even though supply chain issues from the pandemic have subsided a bit. Well, actually, have subsided a lot. So, again, why is existing home sales so low? Why is the inventory so challenged here? It's pretty much because of where we are with rates. About 90% of people who have a mortgage have rates that are below what we're seeing right now. So there's very little incentive to sell your home, trade it up for a new one. Even scaling down, there's a lot of decision making involved in that, because whatever you do, you're going to be paying a much higher interest rate. A lot of people don't want to give up that rate. So that's in its own category there. So as far as all the new homes that we've seen selling, the bulk have been in the South. Land is more available. Job growth has been good there, and the cost of living is more favorable there as well. So if we look at this slide, we kind of give you an idea of what's going on in the remodeling world. Annual spending, if you look at the chart on the left, we expect that to fall from 489 billion to 452 billion over the next 4 quarters. And expenditures on remodeling are going to be positive, but they're going to turn negative in 2024. We expect a drop, but actually, the industry as a whole is looking for about an 8% drop through the 3rd quarter of 2024. So why is this? And again, it's a lot of the reasons that we've just touched on. Remodeling surged during the pandemic, so a slowdown was expected. It was pretty much inevitable. You just can't sustain that level of what was going on. People were home, they had nothing to do. Let me redo the den. Let me paint the living room. Also, there's a pullback in home buying. Obviously, there's less incentive, as we just said. There's less incentive to fix up a home before you sell it. So if you're not selling it, if you're not making that decision to sell, you're also not doing those improvements that you normally would do before you sell. So that's something that's going on as well right now. And again, affordability. The higher prices are leaving budgets very tight. So even if you do buy a house, there's less money in your budget generally for remodeling. You're really extending yourself just to get the house, and so you might be putting that on the back burner for a little while as far as remodeling goes. And then again, the increase in new home purchases, given the lack of existing supply, you buy a new home, you really hope you have nothing to remodel unless you have a really bad builder. So that's you wouldn't want to be remodeling if you're buying a new home. So overall, so among consumers that do decide to remodel, even when they do spend, they're scaling down. They're doing smaller projects, painting, some kind of flooring and things like that. And they're also shifting to cheaper materials. So that's bringing down the amount of money overall spent as well. So with that, I'm going to pass it over to Jerry. Jerry's going to talk about some sales metrics, and then we'll move into some of our spotlight companies.
Great. Thanks, Mike. If we can show the screen possibly. So for the sector metrics, we're not going to cover every company on the slides. Instead, what we're going to do is look at general trends and maybe comment on specific outliers or ones that we're interesting in. Mike will be covering the bellwether retailers like Home Depot and Lowe's, and then I'll touch on the distributors, Builders First and Beacon. If you can slide down to the bottom of the slide.
Sure. Sorry about that. A little bigger than I.
Yeah. So as you see, the overall average for the sector, the sales were down roughly 2% to 21.6 billion. And starting with the distributors here at the bottom, the specialty ones like Wesco, Graybar, Ferguson, Fastenal, these companies cover wholesale large enterprise markets like utilities, HVAC, plumbing, industrial government, and for the most part, sales have been positive, based on resilient industrial production, and GDP growth has been very good. Actually, came out to 5.2, the last one. That was a blowout. In contrast, as Mike was talking, the distributors that cater to new construction particularly single family, they were down. And these are the Builders First, Boise Cascade, and Blue Links. And some of this is because the price of lumber has been dropping. If you go to the top, Mike,
Yep. Sorry.
the retails, like Sherman-Williams, had very strong results. Why? Well, consumers are still painting their houses. And they also had fewer supply chain problems, like last year, where there was still a carry-on effect from disruptions in the Gulf Coast from the winter freeze that we had a couple of years back that disrupted resin supplies, etc. But even though consumers, as Mike mentioned, are still painting their houses, which is good for Sherman-Williams, they're not taking on large projects like, a new bathroom or new kitchen or an extension, and that affects the smaller retailers like, Tile Shop. And sales were soft there, down 5%, and LL Flooring, which has been in the news lately, they're down significantly. Moving on to the next slide.
Sure.
The store counts. Well, for the most part, with few exceptions, most retailers maintain or added stores, the exception being Lowe's, which Mike will talk about. But notably, the companies that have been adding stores were Tractor Supply, Ace, and also Floor and Decor, which has been growing. And they mentioned that they could have added more stores, but they have labor problems. They can't get enough people to build the locations. In terms of comps, the next one, Mike. Retailers are lapping a relatively strong 3Q, and but consumers have cut back on remodeling and making additions. So Floor and Decor, Tile Shop, and LL Flooring have been down for most of the year. And with the exception being Tractor Supply, year to date, sales are up 7%, but the comps were only up 1.5. So how were they able to grow sales? Well, basically they added all those stores that we saw before. And the worst performer is LL Flooring, formerly Lumber Liquidators, and the company basically caters to a lower income demographic, and they've been having problems. They've been struggling for a couple of years now. And right now the company is a takeover target, has a couple of offers, one of them from prior management. And with that, if there's any question, then Mike, you can take on the first spotlight company.
Okay, thank you, Jerry. So we're going to talk a little bit about Home Depot and Lowe's, our two retail spotlight companies. Basically, we call these guys the bellwethers of the industry. As they go, so go many others, right? We're talking about them not because they're a troubled company, kind of issues with them, but because they're experiencing a lot of the problems that we talked about earlier with the housing market, and that's affecting them. And so we'll kick off with some highlights for the third quarter that came out in mid-November. Sales are pressured by consumer preferences for smaller projects, as we've talked about. Slowdown for certain big ticket discretionary categories. Those are things like appliances, outdoor furniture was down, countertops, cabinets, those kind of things. Big ticket items in the $1,000 or more category. And those are really, really suffering right now. Sales and comps were down 3%, and that's on top of a 2% decline in 2Q. Again, traffic is slowing. the basket is holding up, but mostly that's because of inflation and prices are higher. But overall, they're seeing a slowdown in traffic. And if we look at the broken down by category, only building materials put up positive comps in 3Q. All other departments were negative. A lot of that has to do with the pro market, and that's something that we'll be talking about as well a little bit further along. Home Depot is making a big effort to get more of the pro market share. That's a new, not new in the sense that they haven't done it before. They've been doing it for a long time, but they're focusing on it more as a revenue driver going forward. So a bright spot has been the investment that the company's been doing in its online and e-commerce. E-commerce online sales were about 14% of the total, and that was up 4.6% from a year ago. So as we're seeing with a lot of retailers, investments are heavy in the online experience, that kind of thing. Home Depot's no exception. We'll be talking about their online business a little more later on. So for the quarter, down a little bit on the gross margin. Price deflation was offset by lower supply chain costs, which everybody's kind of enjoying. On the SG&A side, that margin deteriorated a bit on higher wages for employees, and a lot of that increase, again, was connected to investments for professional business. The company's making an effort to capture that, as I had said. And when you're dealing with the pro customer, I don't know how many of you have shopped at Home Depot. I would imagine all of you. But waiting for somebody to get you that can of spray paint for 15 minutes won't cut it with the pros. You got to have a employee base that's not only knowledgeable, but they're available, and they're accessible. So that's really why we're seeing a lot of wage investment on Home Depot's part. And that's to cater to the pro who really needs a different kind of employee than you might see on a regular day-to-day basis when you're buying for your home. So overall, when you look at the quarter, it's not something where we're having people running for the exits, but it's clearly some market-driven challenges, and they're managing through them. All right, so if we continue a little bit with the highlights of the quarter, we'll look on the liquidity credit side. Debt was relatively flat, and debt to EBITDA was relatively unchanged at 1.6 times. The company generates tremendous cash flow, $6 billion in the TTM period. Management has stated that it wants to continue to return cash to shareholders. They borrowed $2 billion in November. About $900 million of that is earmarked for share repurchases. Also in November, they had launched a new $15 billion share repurchase program. And but overall, unlike Lowe's, which we'll talk about later as well, the company hasn't indicated whether or not it plans to be aggressive on the share repurchases, what kind of time frame they're involved in. And also, they haven't really commented on whether they plan to borrow money just to repurchase shares, as we've seen at Lowe's. So that's a little bit up in the air. We'll see how that goes. Right now, they're being a little more conservative in how they're managing that, and we'll see if that changes. It certainly has at Lowe's. Liquidity is great, almost full availability on everything they have. 364-day line of credit of $1.5 billion, and $3.5 billion facility in 2027. So there's really no problems there at all. No borrowings, no commercial paper outstanding that would bring down that line either. So liquidity is excellent, and that's what really gives us our A2 rating with this company. They're tops in the sector. They're the one that really leads the way. They deserve their A2 rating based on not the downturn in the business that we've seen recently. We've kept them at A2 throughout that downturn. It's just basically on the strength that they have. The long-term outlook for the home improvement sector is favorable, and Home Depot is a very solid company among that. So we look at some of the things, like we said, we don't feel you'd be worried about Home Depot on a day-to-day basis as far as their performance. So we're looking at some of the things that they're doing to grow the company. One of those things is store growth. Since 2008, the company's improved productivity, but it hasn't been through new stores. Sales are up about 110% over the last 10 years, a total of $83 billion. But retail selling space has been almost flat. It's only up 3%. And they're squeezing a lot. They're getting a lot of juice out of the lemon. But, at some point, you might want to have to think about what you're doing. And that's where we're at right now. The primary strategy is to identify areas that have experienced population growth and where there are market voids. I don't think that breaks any new ground. I think you wouldn't expect them to do anything less. But again, they haven't really grown that much in the past 10 years or so. They're targeting about 80 new stores in the next 5 years. And generally, you would say, well, 80 stores in 5 years, that's not all that much, right? But they've only added 66 over the past 10 years. So the average per year is really, really moving along. It's going to be kicking up. 2023 is year one of that 5-year period, and they expect to add 13 by the end of this year. Again, not a huge number, but it's signifying a change, looking to grow a little more on the storefront side. Another area that the company's looking to grow is in its online business. I was a little surprised to find that Home Depot is the number 5 retailer in the country. I know they do a lot of business, but I didn't think they were number 5, especially when you look at the 4 above them. They're all pretty big players in the online arena, obviously Amazon and Walmart. But they're number 5, and they're looking to grow that. And they currently have about 3.5 billion visits to their website a year, and they do about 1.7 billion transactions. So overall, all that activity adds up to about 15% of sales in general. But where Home Depot is really, really excited, I guess you could say, is the fact that 60% of the customers, 60% of their total sales are the customers that shop both online and in store. So they want to have that relationship where they can leverage one to the other. If you're buying online and you're picking up in store, you're a store customer, you can pick things up there as well. And conversely, if you're in the store, you're thinking about something else that might not be available there, you might look at the website where they have a broader product assortment. And so connecting the two per customer, getting them familiar with the online as well as in store, makes for what they believe is a much better customer than someone who's strictly buying online. And for fiscal 2022, about 50% of all online orders were fulfilled through the store. That's also helpful in the sense that, again, you get people either coming in to pick up or have delivered, but the store, it makes it easier to deliver. A lot of stores, a lot of distribution availability to homeowners, to residential areas. On the downside, if you don't do it right, you could possibly reduce store traffic. You don't want to do that, and that's part of the reason why they tout their 60% total sales to customers that are doing both. And also with online, you can have higher costs for delivery, and that could impact your margins. But again, the fact that they're doing so much fulfilled through a store, that tends to mitigate that and makes things a little more palatable in the online world. And also the online initiatives that they've been investing in have been to enhance site experience, make it easier to navigate, easier to find what you want. There are a heck of a lot of Home Depot SKUs out there. Any home improvement company has a lot of SKUs. It's tough to sort through them all, especially when you get into different things like sizes and finishes and things like that. So they're trying to make that a little easier to navigate. They also are looking to improve the professional area, which again, very important. Pros don't have a lot of time to mess around. They want to get what they need, find it quickly, get the information they need about it. So a lot of investment is going on there as well. All right, so with that, we'll move on to gross margin a little bit very quickly. For the past year or so, the improvement has been pretty much because of supply chain cost coming down. That's we had the supply chain issues a couple of years ago, and now we're seeing that coming down, and that's improving margins a lot. For Sherwin-Williams, sort of good margin improvement. Their paint business is doing extremely well. Paint prices are very high. They're enjoying that right now. Again, that move to smaller projects. I might not be able to do a new kitchen, but I certainly can paint it. So that's important. If we look at Home Depot and Lowe's, the companies we're talking about now, margins have been relatively flat. Price deflation has kind of been offset by those lower supply chain costs. So that's keeping that relatively flat. Beacon Roofing, we'll see that they've actually shrunk a little bit. They're dealing with input cost increases over there, and that's hurt margins a little bit. So moving to SG&A, again, we see a little bit of deterioration, and that's mostly on sales deleverage. We're seeing in the earlier slides, we're seeing that sales have been pressured and moving down a little bit. So a lot of that deleveraging is impacting the SG&A margin. If we look at Home Depot and Lowe's, for Home Depot, again, those employee costs that I had mentioned are dragging that down a little bit. As far as Lowe's, productivity initiatives are part of that improvement. They had a one-time undisclosed legal settlement that is included in their financial statements, couldn't break it out. So that's really where that's coming from. So with that, we'll move to Lowe's. We'll talk about them a little bit as well. Very similar to Home Depot. I like to think of them as they're number 2, but they try harder. We got a lot going on here. They have, as far as their third quarter highlights, sales were down 13% to $20.5 billion roughly, but $1.2 billion of that was due to the sale in February of this year of their Canadian business. They've completely exited Canada, and that was worth about $1.2 billion on the top line. Comps are down 7.4. Again, average ticket not down that much, pushed up a little bit by inflation, but it's really the traffic that's a problem, and that's well down below what Home Depot is putting up. Part of the problem there is a problem for now, I guess you might say. Lowe's is more geared toward the DIY shopper. Its stores are definitely more DIY friendly, more consumer friendly. They have a different kind of layout, and their design caters a bit to the DIY consumers. So that's a bit of an issue there. So that's why we see traffic down a little bit more than we see it at Home Depot. If you've been to both stores, I think you'll notice Home Depot has a bit more of a warehouse type of feel, whereas Lowe's tries to be a little more well lit, a little more organized as far as their aisles and things like that. So if we continue on, despite the soft demand, comp sales are growing with the pro. Again, both companies are heavily involved with the pro. It's not that they haven't done it before, but it's a highly fragmented market, a lot of mom and pop type shops, and both of these companies think that they could do what they did to residential consumers with the pro and bring that all under their umbrella. How much they get of it is obviously in question, how much ultimately goes to them, but they're definitely making a serious pitch to become the pro source. Debt way up for these guys. We'll talk about that in the next slide or two. Up $7.5 billion, mostly because of share repurchases, and we'll talk about the contrast between Lowe's and Home Depot in that regard. They intend to continue making share repurchases. They have their foot on the gas pedal and have not taken it off. Management has said that it believes it can take its leverage to 2.75 and maintain its BBB plus credit rating from S&P. No doubt that if they're at 2.75, they'll still have that BBB. But it's a matter of how much they actually borrow that we're going to see. Our debt to EBITDA is in the 2.5 times range, and they're calculating it a little bit differently as far as S&P is concerned. Again, liquidity, much like Home Depot, full availability under their facilities, $4 billion, plenty of liquidity. So that's not a question at all either. Again, solid company, but we're going through some struggles on the product side, on the demand side, that kind of thing. And also, as we manage, we'll see they're a little more aggressive in how they've been attacking the share repurchases. So last year, they bought 14 plus billion in stock back. And so far to this year, 5.7. And a lot of that was funded with new debt. If you see that chart on the bottom, that's in just the past 18 months or so. They've borrowed $12.75 billion, almost $13 billion, mostly to buy back shares. Not all of this has been to buy back, but a serious amount has been for share repurchases. In addition to that, to the borrowing, they're using their cash flow as well, which is extremely strong. It's about $7 billion last year. So they're using that, but that doesn't cover $14.2 billion in purchases. So, when you look at this, you might say, there's both sides of the argument. You can ask a slew of people and you'll get two different opinions. Some are saying it's great to return cash to shareholders. We want to see that. Many times they'll be on the equity side. But then you also have people who'll say, this is money that could be reinvested in the business, whether to grow or to improve, the stores that we have now, that kind of thing. It's really neither here or there as far as what's right. But you can get into trouble if you over leverage, I guess, if you borrow too much money to make these purchases, get over your skis a little bit on the leverage. And it's indicative of a little bit of an aggressive policy. And if we look at the chart on the right, it hasn't really done a whole lot for the stock price up until this point. The past couple of years, we're actually down off the peak in 2022, and it hasn't really propped up things tremendously. I haven't really seen a big bump on that. So if we move down and go to the next slide, we'll look at their outlook for next year, the rest of and this year. We're looking for sales of 86 to 89 billion. Again, that's considering the impact of the sold Canadian business. So that's why that appears to be larger than you would have seen it with Home Depot when we were talking about them. Comps down about 5%, we're expecting. Again, that's that traffic related issue. They are having that problem with traffic. Got to get that up a bit. Margins pretty well holding up a bit. They expect about the same. They picked that to be about flat, a little up. But still, over the course of the year, that prediction has come down as we've gone through the year, and as this is the problems that we're seeing in the marketplace accelerating a little bit. Capital expenditures about $2 billion. That's about the same as throughout the year, up a little bit from last year. And we just want to point out that fiscal 2022 is a 53-week year. Also, we talk about growth initiatives with Lowe's. As we spoke about with Home Depot, they're investing in their pro offering. They're going after Tractor Supply. In a sense, they expect to have about 300 stores offering additional farm, ranch, and outdoor products. That's really Tractor Supply's wheelhouse to differentiate between them and Lowe's. About 300 of those stores are going to be in the South, Midwest, and Northeast. And they're also trying to promote a store-in-store concept along with that strategy. They're expanding Petco store-in-stores to about 300 stores as well by the end of the year. And that's tied to the Tractor Supply situation with those rural stores. And with that, I'll hand it off to Jerry again.
Okay, well, the margins, EBITDA margins, is kind of a summary statistic for everything that we've talked about: the sales, the gross margin, and SG&A margin. As you can see at the bottom again, for the sector, last year the average was 13% EBITDA margin, whereas this year it's running at 12.7, essentially flat to slightly down. Most of the companies have some pressure on margins, primarily because of the gross margin compression. Haven't been able to pass all of the cost inflation along, and on the SG&A side, we've had higher wages and salaries, which are putting pressure on margins. Moving right along, I want to go to the next slide so we can start. I want to stay in time. We're looking at Builders First. This is one of the spotlight companies we're looking at because of their active M&A activity. As you know, Builders First was basically doubled in size. There was an acquisition, it made an acquisition back in 2021 with BMC Holdings, basically doubled the size of the company. And they continue to grow through tuck-in acquisitions. On the right, you see that they've made over 12 of them, and 5 of them in 2023. And basically, the management strategy is to reduce, commodity product exposures, which are lower margin, and try to shift into more higher profit, value-added markets. So one way to do this is to increase the exposure to multifamily and complementary products like windows and doors, which then balances out the size of the single family business. So if you look at the fourth quarter of 2021, about 45% of their product mix was value add, whereas in 2023, coming to the end of this year, it's going to be up to 51%. And once you start adding more of the value product, you're going to start seeing a higher gross margin and stronger EBITDA margins, which we just covered before. One of the things that the company is also doing is they're pushing into software. And you'll say, well, why does a building supply company, purchase a software company, WTS Paradigm? This was back in 2021, and the idea is to give the customer a better experience. They're able to track orders, also see how many components they have, and where they'll need additional capacity. And this strategy of these tuck-in acquisitions, each individual one may be small, but when you add them up, they start to move the needle. And in this case, with Builders First, they've added about $800 million in revenues since 2021 on acquisitions of truss and millwork businesses, which is where the value add part comes in. Next slide. We're just going to go through these quickly for the sake of time. Through the third quarter, sales were down 21% year over year and down 25% on a fairly TTM basis, as we saw before. And, EBITDA is down 31%, again, on lower net sales and commodity cost inflation, because some of these commodity products, they have a labor component, a lumber component to it. Sorry, lumber is down almost 20%. The company's liquidity is fine. EBITDA is at 1.2 times. It's higher primarily because of the weakening of EBITDA of earnings. But the company has no long-term maturity. They have a revolver, and they could deleverage if they wanted to, but they're repurchasing common shares, like Mike was talking about, that they've up to about $1.6 billion. So going to the next slide. Looking for 2024 longer term, this year essentially they're going to, sales and EBITDA are going to be down. No surprises there. They're able to maintain their gross margin, again, because contributions from the value-added businesses. And what I want us to look at is the progress to date on their original long-term targets. Originally, it was from 2021 to 2025. They had aggressive targets, and up to now, they've only been able to grow revenues 3%. EBITDA, they've done better, and margins, they've also done better through cost controls. But, longer term, they're just going to grow a little slower than they originally projected, but it's still a healthy growth rate. On to the next slide, Mike. This is a CapEx margin. I'm not going to spend a lot of time here. Again, the companies that are investing, and for the most part, they're investing in digital infrastructure, improvement in their processes, also to improve their distribution and logistics, lower cost, and provide better customer service. The ones that had the increase in CapEx, the largest ones were retailers like Floor & Decor and Tractor Supplies, because they're also adding stores. Next slide, Mike. So on Beacon Roofing, again, Beacon is another one of these retailers, distributors that's been growing through acquisitions. They, it's one of the top 3 national roofing distributors, and it scaled from 2 prior acquisitions. We called Roofing Supply in 2016 and Allied in 2018, and they've made basically 12 acquisitions since 2022. And again, each individual one may not be significant, but collectively they've added $400 million in sales. Management is also focused on, diversifying the product line, just like Builders First. They sold their interior products business about 2 years ago, November 2021, I recall, and that business had a sales of about $1 billion. The company sold it for $850 and used about $750 to reduce the debt. And they are now, again, pushing into the value added. They recently purchased Gavin Construction, and Gavin Construction specializes in waterproofing products. So that's like the plastic liners that you see on when you're building houses, the plastic liners that you see before they put the sheetrock and the siding on. And these are products to wrap exterior walls and creating moisture shields and waterproofing. Again, these are complementary products that the company is pushing into. Next slide. So the big news with roofing is that it's always steady. It's relatively, year in, year out. There's demand, and especially when there are severe weathers, hurricane, tornado, active, the roofing demand shoots up. Well, why? Well, because you can't just keep putting buckets of water under the roof to collect it. You have to fix it. You have to replace it most of the time. Roofing, primarily 75% of it is primarily residential. And the company then is looking to diversify into the complementary products. So the sales mix, if you look at the sales mix here, in the middle, you'll see that 53% was residential, 26 was non-residential, and 21 was complementary, whereas a year ago it was 20% complementary. So they're moving the needle on complementary products, which, as you saw on the right, you see a little bar chart. It's up, 14% year over year. Next slide, Mike. Again, here's just the outlook for the company. They're going to finish the year with sales up about 11 to 13%, although gross margin may be a little squeezed on higher product costs. But the outlook is good for the company. They continue to grow, and now they're actually expecting to resume share repurchases. Mike was talking about that. Hopefully, they're looking to use either cash flow or revolver borrowings to repurchase their shares. Next one, Mike. And this is a percentage available under the credit facilities. This is like a metric that we look at as for red flags. A red flag is any company that is consistently below 25% revolver availability. It means that their liquidity might be unavailable, since most companies use the revolver as a quick source of liquidity of cash. So recall that, and also as a safety mechanism, recall that during the last COVID period, a lot of companies drew under the revolver just because they didn't know, because they wanted the cash. They didn't know what uncertainties COVID would bring. Eventually, after everything got settled, a lot of the companies just repaid back their revolvers, and their availability has resumed. So the next one is total debt to EBITDA is another red flag or warning metric for us. Anything above 3.5 times total debt to EBITDA is a warning sign, and basically the company might be too leveraged. In this particular case here, leverage was kind of flat. Most companies have manageable debt loads, and despite their weakening earnings, most companies still have decent leverage. Most the ones that are high are the Wescos, the Blue Links, anything companies related that have had acquisitions which were financed with debt will typically have some of the higher metrics. And with that, Mike, I'll turn it over to you.
All right, so I'm going to quickly finish up over here. Sorry we went over a little bit of time. For TTM interest coverage, we like to say that below 3 times is a warning sign. For the most part, we have our companies that we're covering in good shape. Some of them are approaching 3 down at the bottom there with the suppliers. A lot of that has to do with declining profitability that we've seen over the past year. As things smooth out, we might probably see that move up again. The only exception here is LL Flooring, which is quite the mess. And we'll see that probably the next time we do this in some different form, whether it be as a restructured company or owned by somebody else, but it definitely be different. Move on to our stock chart. We're just giving an idea of where these companies are trading as equities. For the most part, all these stocks are trading near their 52-week high, not too far off of it. The rebound in prices after coming off of the pandemic era highs are what's really at play here with the large percentage gains. The sector underlying strength is also a major factor as to the improvement in stock prices. The overall market is also contributing to the appreciation there as well. And then again, we have LL Flooring, which has that $3 a share offer. So, you might actually lose money if you bought it at $3.33. And we'll go finally our credit ratings. And as we've said throughout this webinar, we are confident in the strength of the sector. 13 of our companies are rated A or B. A couple of upgrades in there. 6 are in the C range, which it's still a viable company. Nothing that you really have to worry too much about. You might want to keep your eye on it a little more. And then down at the end, our friend LL Flooring, falling fast at D2, and that's the company that we have throughout the whole sector that really has some problems, which we've been reporting on as we going along with the buyout offers and things like that. So that's really a one-off case. And with that, that concludes our webinar. We appreciate your time. We appreciate you listening to us, and we apologize for going over a little bit on time. If you have any questions that you want to ask us, please feel free to email or call us. We're happy to hear from you at all times and help in any way we can to get you the information that you need. With that, let's say thank you and have a great day.
Bye-bye, everybody.